Good morning, good afternoon, and good evening, ladies and gentlemen. Today we'll take a bit of some time just to analyze the Zambia Brewery's PLC financials. We are not doing any disservice to anyone, knowing too well that Zambia Breweries is listed on our stock exchange. So I think it is just in order. It is our civic right just to look at the numbers and just break them down. So when we look at their financials, there isn't so much detail given. Remember that this is just 3 pages, so most of the costs, we don't know what is in those cost categories or report lines, but we can just assume. So when you check on the income statement, under other expenses, there is over 459. There is over 459 and 70. Yes, this is in what? I don't know if it's in millions or what. They didn't even show it. I don't think they're actual numbers. So in here, I would assume this is where you have maybe provision for doubtful debts, exchange gains and losses, obvious exchange losses. I would have expected the financials to have isolated this number, to have been just down here under just after finance costs or before finance costs, so that we just get to know what is in other expenses. But this is a huge number. When you look at the cost of sales, I think it's just even because the gross profit margin moved, I think, from 44% to 42%. So there isn't much to complain about. Then the distribution costs, yeah, slightly going up. Administration expenses went down, almost like contradicting to what they have written down here. As in, following a strong start to the year, our overall results in 2020 were significantly impacted by the disruption caused by the COVID-19 pandemic. I'm not able to see it in the numbers, other than that huge number on the other expenses. Then they go on to say, however, the steep depreciation of the kwacha and the volatile inflationary environment faced during the period eroded our margins significantly, with production costs rising 21%. Again, here, I'm not able to see that rise. So if I go to my Excel, let me just go to my Excel or before that. And somehow think this 21% is linked to the inflationary rate, to the inflation rate, sorry. The gross margins were down by 15% compared to the previous year because of the cost escalation in the supply chain. Again, looking at the numbers, I couldn't see this 15% because the gross profit margin was about 44% in the previous year, and in the period under review, it was about 42%. So I couldn't see that. Here, however, they go on to say, however, adverse macroeconomic coupled with transaction effects and commodity headwinds will pressure our financial year 21 Ebitda margin, of which, and again, it's so strange because this Ebitda margin that I've mentioned it here, ideally, we expected that it should have been included in their financials, in the numbers. They didn't do that. So it was another error. They didn't do that. But what is so interesting If you go to the cash flow, okay, let me go to my Excel sheet. Where? So I extracted these numbers from their document, which they have posted. What is so worrying it is the trade payables. Check on the trade payables. They are actually higher. Trade payables are higher than the cost of sales. This is a very huge problem. And it's not coming in because of COVID, but when you look at their report, it is giving an impression that COVID had a serious impact on the business, but I couldn't see it, because even in 2019, before COVID impacted us to the fullest, but I think maybe in Zambia we started getting these cases around March 2020, somewhere there. Their cost of sales was very high. Their trade payables was quite high. And this is how they've been raising cash. So it shows on the suppliers, cash raised from working capital. This is on the trade payables. In 2020, they managed to raise 240, 60 from receivables, inventory, about 104. In total, cash that was actually raised was 405 or 406. I don't think their working capital management, I don't think they have been managing their working capital so well. You can see here, evidently so, that the working capital, that the suppliers are actually disadvantaged. In 2019, the trade payables days was at 420. In 2020, it has actually increased to 432. Therefore, releasing 241,000. I don't, 241 million. I should guess these are millions. 240 million. Inventory days have been going down. There could be two things happening here with the trade receivables going down as well. There could be two things happening. One of possibilities that the suppliers are actually getting tired. They could have come up, maybe they've come up with quite stringent measures, like maybe demanding cash before they deliver. This could also be a possibility. But the days have really gone down on inventory. The other one could be a strategic issue where they just want to exhaust whatever is in their stores. This could be another strategic thing. Trade receivables days, you can see what is happening here. It could be that their accounts of finance department has become so aggressive in collecting the monies from wherever they are owed, going from 45 days to 24 days. That is quite steep. So they're getting more money from whoever is owing them, yet under trade payables, they are not collecting anything. If anything, suppliers are actually highly disadvantaged. Coming this side, here wanted to calculate depreciation because in their financials are highly condensed that you have to work backwards to check. I calculated depreciation for a simple reason that I wanted to check what was their Ebitda. So it shows their Ebitda was at 229. Let me do this. So this was their operating profit. or add back depreciation, it takes you to your earnings before interest, tax, depreciation, and amortization, which is 229. This Ebitda, it is a very important metric because this is basically operating cash that you're generating from your operations. But then what they did, they invested how much? How much was invested? Invested about 200, let me say 300 million. But this 300 million, looking at the Ebitda, which was that, they paid tax of this much, they paid their lenders 16 million kwacha in interest, meaning that the cash before working capital engineering, they only had 117 million, of which one would expect that maybe this is so much that they should have actually invested in here. So in short, they over-invested. So in terms of the low lights, this is a low light, which obviously the board has to work on, or management. This is a low light. We expect the numbers here under trade payables to be almost equal to the trade receivables or slightly higher, at most maybe 60 days. Maybe 60 days. So once they do this, you see that the suppliers, whatever cash they were releasing here will actually reduce, might even be negative. So they're releasing more cash from the working capital. So the gross profit margin, like I said, in the report is showing 15%, but ideally it just went down by 2% from 2019 to 2020. When we look at the holistic picture. Made additions on PPE of 297, but the total investment was about 300,000, which was 299. Yet they only had operation cash, the Ebitda of 230 million, less 115 million, which they paid to the Inland Revenue Authority and their lenders. The cash before working capital was 117, and cash released from working capital, like I had already said, was 405. So this is it. I hope you enjoyed the session. Maybe I can still go back to the financials let me just go back to the financials. So you can check on these financials. So the cash and cash equivalent at 401, but remember that this cash largely is coming from working capital engineering. I don't think it's a strategic issue on why the suppliers are not being paid, that they have gone to over 430 days. I don't know why. Is it over 430 days? Let me just check. Let me just check. Yeah, 432 days. I don't know why. This basically shows that financially they are constrained, and also raises other issues that even in 2019, when they had given dividends of 274 million, they were literally getting it from the suppliers. That's what it means. Because for the suppliers as well, the trade payables days was over 400 days, 420 days. And the and the trade payables in terms of the obligations, the payables were $1.34 million, 1.3 million kwacha. This is quite huge. I don't know, it's 1.3 million kwacha. Oh, yeah, it should 1.3 million kwacha. So this is, I don't think these numbers are correct. It should be 1.3 billion, 1.3 billion, because I don't think they can make 2.3 million kwacha in revenues, or 2.3 million kwacha. This should be billions. Thank you so much, and bye-bye.